All right, are we ready? Great, great. Welcome, ladies and gentlemen. My name is Larry James. My company is Speak with Larry, no spaces. And what my company does is teaches people how to set up the foundation of an online business while assisting them with becoming more comfortable speaking about it. Now, for the next 90 days, I've taken on the challenge of learning the stock market. And I'm also going to be inviting other people in via Zoom to participate, put in their 2 cents or just pay attention and learn as I share information about the stock market. It's one way that it helps me to solidify what I need to know about investing in the stock market because I'm preparing to invest more money. And when I invest more money, I like to know exactly where my money is going and how things are working. And I recommend that you take that same path if you're interested in maintaining and growing your money. But either way, what I wanted to do today is introduce you to the title. The title of this episode is Understanding Terms and Definitions in the Stock Market. And what I'm going to be doing is I'm going to be archiving these videos. And at the end of the 90 days, I'm going to package them and I'm going to market them to an audience that I'm creating, right? That's how business works. This, again, is the same concept that you would be doing when you decide to set up your online business via videos, right? There's several different ways you can create income from doing that. And I'm going to be sharing several of those ways with you guys during this 90-day period. So I hope you stay around. Don't forget to share and like these videos. You know how the internet game is played. And what I'm going to start off with today is I'm going to read a couple of things that I want you to pay attention to, basically because what you're learning here is the understanding of the language that's spoken in the stock market. There's a language that's spoken in any venue that you go into. If you know that language, you can take advantage or strategize. But if you don't know that language, you're at the mercy of that system. So it's always good to gain more knowledge on different things that you're interested in doing. So I'm going to begin with the first term and definition that I want to share with you today. Is called averaging down. Averaging down, it says, this is when an investor buys more of a stock as the price goes down. This makes it so your average purchase price decreases. Now, as I share these definitions with you along this video, just be mindful that I'm learning like you're learning. I just believe that when people hear things, then they gotta have a tendency to hold it longer or process it differently. So if I don't understand exactly what these are, then I'll go and do a little bit more research on that particular term so that I'll know, right? But it's all just about having it in your wheelhouse as far as understanding. The next one is called a bear market. This is trading talk for the stock market being in a downtrend or a period of falling stock prices. This is the opposite of a bull market. So you have a bear market and a bull market. Bear market, stocks goes down. Bull market, right, stocks go up. Simple enough, right? Next, I want to talk about beta. Beta is a measurement of the relationship between the price of a stock and the movement of the whole market. The price of a stock and the movement of the whole market. Now, we're going to go into blue chip stocks. These are the large industry-leading companies. They offer a stable record of significant dividend payments and have a reputation of sound fiscal management. Those are considered blue chip stocks. So when you hear these terms, let them resonate in your mind, because when you become engrossed in this world, then you pick up on things really quickly, right? The next one is the bull market. This is when the stock market as a whole is in a prolonged period of increasing stock prices. Again, the opposite of a bear market. Next, we have a broker. A broker is a person who buys or sells an investment for you in exchange for a fee or a commission. That's one of the ways they make their money. And if you watch the prior two videos that I've created, uh, I explain a little bit more about the different ways that brokers make money. So feel free to go back to those. You can always go to uh, my YouTube channel at Speak with Larry. Just go to YouTube, type in Speak with Larry, and then go to the stock market playlist. It says stock market videos, and all these are going to be there. Next, I want to talk about day trading. Day trading is the practice of buying and selling within the same trading day before the close of the markets on that day. Hence the term day trading, right? Some of you probably already know these, and that's good. But there's probably a few that you didn't know. Next, I'm going to go into dividends. Dividends, this is a portion of a company's earnings that is paid to shareholders or people that own that company's stocks on a quarterly or annually basis. Not all companies do this. Not all companies offer dividends. Some companies keep their shares to their stock to grow more money, to grow the company faster. And I'll explain that a little bit later. Next, we have exchange. An exchange is a place in which different investors are traded. Different investments, I'm sorry. An exchange is a place in which different investments are traded. The most well-known in the United States are the New York Stock Exchange and the NASDAQ. Number 10, execution. When an order to buy or sell has been completed, that's considered an execution. If you put in an order to sell 100 shares, this means that all 100 shares have been sold. Number 11, hedge. This is used to limit your losses. You can do this by taking an offsetting position. Now, you probably don't understand that part because that's on the next level, and you'll get there. Don't worry about it if you stick with it. But there are ways you can hedge your investment so that you don't lose money or you don't lose as much money. Next, index. An index is a benchmark which is used as a reference marker for traders and portfolio managers. Now, at any time, you can always, stop this and pause and go back. That's why I want to make certain that, I read this correctly and you get an understanding of exactly what I'm saying so that, I don't mislead you. Now, number 13 is called an initial public offering or an IPO. This is the first sale or offering of a stock by a company to the public, rather than just being owned by private or inside investors. In other words, this is when your company goes public and you create shares for your company. Next, we have margin. A margin account lets a person borrow money, take out a loan, essentially, from a broker to purchase an investment. That's a margin. Followed by moving average. Moving average, a stock's average price per share during a specific period of time. Sometimes frames are 50 to 200 day moving averages. 50 and 200 day moving averages. Number 16, order. An investor's bid to buy or sell a certain amount of stock or option contracts. You have to put an order in to buy or sell 100 shares of stock. Portfolio. Now, you're probably familiar with portfolio. That term doesn't really, change too much. But in the stock market world, it's a collection of investments owned by an investor. You can have as little as one stock in a portfolio to an infinite amount of stocks. And you always want to have those in a strategic way. That's why it's necessary to understand the game so that you can formulate a strategy to invest your hard-earned cash, right? Number 18, quote. Information on a stock, latest trading price. This is sometimes delayed by 20 minutes unless you are using an actual broker trading platform. Number 19, rally. Rally is a rapid increase in the general price level of the market or of the price of a stock. That's considered a rally. Number 20 is interesting too. This is called a sector. A sector is a group of stocks that are in the same business. An example would be technology sector, including companies like Apple and Microsoft. Makes sense, right? Those are sectors. So you can actually purchase stock according to the sector that you have a affinity for. Like you might like technology and you might want to buy Apple, Microsoft, different technology stocks. Number 21, spread. This is the difference between the bid and the ask price of a stock, or the amount someone is willing to buy it and someone is willing to sell it. Number 22, stock symbol. A 1-character to 3-character alphabet root symbol which represents a publicly traded company on a stock exchange. Apple's stock symbol is AAPL, for example. Volatility. This refers to the price movements of a stock or the stock market as a whole. Highly volatile stocks are ones with extreme daily up and down movements and wide intraday trading ranges. Number 24, volume. The number of shares of stock traded during a particular time period, normally measured in average daily trading volume. Number 25, yield. This usually refers to the measure of the return on an investment that is received from the payment of a dividend. This is determined by dividing the annual dividend amount by the price paid for the stock. Let me repeat that. This is determined by dividing the annual dividend amount by the price paid for the stock. How cool is that, right? Now, I want to stop right there for a second and thank you guys for participating in this process, because it really means a lot to me, and it's probably going to benefit you in the long run if you're actually paying attention to what's being offered here. But one of the things I like to do is I like to share quotes. I like to read quotes on a daily basis and post quotes on a daily basis. And sometimes I listen and I find quotes that are really fascinating. But I want to put some quotes in your mindset today that are in line with the stock market. But first, I want to share a couple of what I consider power quotes that I learned this weekend from some research I was doing. The first one says, you may have heard some of these too. Your circumstances don't determine the outcome. Your choices do. I like that one. And then there's a guy by the name of Al Duncan. He gave this quote. He said, exceptional service to others is the price of greatness. Exceptional service to others is the price of greatness. Think about that. To anybody that that's you would consider fantastic or great, they have made a sincere commitment to greatness by helping others. Next, it says, the train to greatness and success is not public transportation. In other words, the way this Boyce Watkins described that, he said, sometimes you have to leave everybody by yourself, alone, and go by yourself. You have to get on that bus by yourself or that train by yourself. And, and then people will start to gather around later. Another I want to share says, you're guaranteed to win once you defeat the enemy within. I like that one. That was really a clever play on that. And let's see, one more. You have to understand the profit producing power of your mind. In other words, you have the ability to do great things, but if you keep telling yourself or allowing other people to tell you that you can't do it, then you're going to stay on that part of town believing that. But you'd be surprised what actually happens when you take action on some of the things that you want to and should be doing, because we only live once, right? And you would be surprised what you can actually do, what your actual capabilities are. But you have to stop being around people who tell you what you can't do. And you have to stop relying on your belief in you to be based on what somebody else sees or says, right? You can't do that. Okay, now I'm going to continue on with a couple of other things I wanted to share with you on this video that are in line with the stock market. And this one says, how to choose stocks. Stock market experts suggest using 5 criteria to evaluate investments. Number 1, asset utilization. Number 2, current and projected profitability. Number 3, earnings momentum. Number 4, capital structure and intrinsic instead of market value. Capital structure and intrinsic instead of market value. Investors without an advisor should perform their own due diligence. And I'll share with you what due diligence is shortly. Now, we have earnings and recession. No, earnings recession. Earnings recession. That's when the S&P 500 earnings decline on a year-over-year basis during 2 consecutive quarters. Industry experts call it an earnings recession. The S&P 500 index historically reflects the GDP, or the gross domestic product, in the United States. Now, like I say, some of these are going to kind of just whoosh, go over your head, and that's okay. But you have heard them, right? So you know they exist. So when you're doing research from time to time, you'll say, hey, I've heard that. Let me find out exactly what that is. And you'll know, you'll have an idea. And you can go back to this video or Investopedia. Next, we have risk cycle. The risk cycle examines the broader psychology of participants in the stock market. The risk cycle is a way to measure the collective mood and subsequent actions of investors in the stock market and the economy in general. That's risk cycle. See, these are informative terms that probably, you never heard, but are really valuable in this industry. Next, we have stop orders and market orders. Stop orders give instructions to buy or sell a stock once it reaches a certain price. Market orders buy or sell a stock at any price. Again, stop orders and market orders. Very interesting, right? Next, we have public company review. Investors must research the enormous amount of data available on public companies to determine whether they are suitable for their portfolios. Because everything you don't want in your portfolio, you want your system to be strategic. You want to be able to be proud of what you're putting together, right? Next, we have dollar cost averaging. Dollar cost averaging is a stock market strategy that can help decrease the risk that come with an asset falling in price. The basic concept is to invest a set amount of money in an asset once every set period of time, followed by efficient market hypothesis. Efficient market hypothesis. That's proponents of the efficient market hypothesis claim that you can't beat the market with stock picking, but the market can't beat you either. That's called the efficient market hypothesis. So if I ask you, so do you know what the efficient market hypothesis is? It basically says that you can't beat the market by picking stocks, but the market can't beat you either. Interesting concept, right? Now we have due diligence. I told you we we're going to talk about due diligence. Due diligence, the internet offers free real-time access to stock data at your fingertips. Consider whether a company's industry, sector, and enterprise is consistent with your asset allocations. Now, finally, we have Dow Theory. The Dow Theory forecasts the market in an uptrend when the Dow Transportation Averages and Dow Industrials make a higher high either at the same time or one after the other. The market is in a downtrend when the opposite is true. Now, Warren Buffett, the superstar investor, Warren Buffett says interest rates are the most important factor when determining stock values. If interest rates are low, Buffett says any stream of earnings from investments will make more money. He's an expert, so you can't deny that. And anything that someone is an expert at, you have to take that for what it's worth, right? Just like people who will come on this video and this series of videos and have a dialogue back and forth on the Zoom platform, we'll get to know one another. We'll get to share information. We'll have actual conversations about certain stocks, about certain topics, about certain definitions, about certain strategies, because over time, that's how this process works. When you're investing in stock market, you're not looking to get rich tomorrow. You're doing this over 10, 20, 30, 40 years. So you want to have a strategy that is effective, especially if you're like my age. So I don't have 10, 20, 30, 40 years. So I have to position myself knowledge-wise to know exactly what I'm doing rather than just guessing or gambling. That's not how I want to, invest my hard-earned money that I worked for over my career. No, I want to know where my money is going. I want to be able to monitor it, watch it, and I want to be able to choose what exactly I want to purchase. All right, that's how you should want to be too. You don't want to have to be forced to buy anything that that's not in line with you or your character, or spirit. All right. Well, listen, it's been a pleasure sharing this information. I love doing this kind of stuff. And you can see I'm kind of comfortable with it, right? This is something that I've been working on for 10 years to get comfortable in front of the camera, right? And I'm comfortable in front of the camera, even if it looks like I'm not, right? But I think it does. But again, I want to appreciate you guys for stopping by. Again, if you want to join this, I do do these videos on Tuesdays and Thursdays at 7 p.m. Central Time. Simply shoot me an email to lowercase Larry 5969 at sbcglobal.net. And in the subject box, type in "Let's Talk Stocks," right? Do that like a day or two before so that I can see it in my email box. And then when I send the invitation out, you'll be sure to get one. And you can just hop in and you can just, if you know more about the stock market than I do, which probably you do, we can, allow you to speak about it. And then whoever else is in the audience get a chance to gain that experience, right? And then when people watch the videos, boom, they'll get a chance to gain that experience. All right? That's how the game is played, ladies and gentlemen, and that's how it works. Again, my name is Larry James. My company is Speak with Larry, no spaces. And as always, share with someone else what I've shared with you.